Okay, recall that we said earlier that a byproduct is a product that emerges from a joint process. And that byproduct, as compared to the other products that come out of the process, the byproduct is the one or ones that have a relatively small sales value. Alright, so due to this inconsequential value, it is not beneficial to expend a large amount of resources accounting for byproducts. But we are going to go through and see two different methods that are utilized to account for these byproducts. We have one called the production method, and it recognizes the byproduct inventory as it is created and the sales and the cost at the time of sale. Okay, so notice that it says the sales and the cost at the time of sale. And then we have another one that's called the sales method, and it recognizes no byproduct inventory, and recognizes only sales at the time of sales. Therefore, the byproduct costs are not tracked separately. And we're going to see a side-by-side comparison of these. Alright, so what is our deal here? We've got the production method. This is the one that's consistent with the matching principle and is therefore the preferred method. Alright, so expenses are following the revenues. That's why we hold out on recognizing those until the time of sale for the actual byproduct. The production method recognizes the byproduct inventory in the accounting period in which it is produced and simultaneously reduces the cost of manufacturing the main or joint products, thereby better matching the revenues expenses from selling the main product. Okay, so the expenses for the main product under this method are showing up lower than the other method that we're going to take a look at because of how the byproduct costs are being taken care of under this method. The sales method is simpler though, but it allows a firm to manage their reported earnings by timing the sale of their byproducts. Alright, so we've got a company that processes timber, which of course we all know is trees or wood, and they process it into fine grade lumber. That is the main product, and their byproduct is wood chips. They incur $150,000 of the joint cost for direct materials and another $100,000 in joint cost for conversion cost. And we're going to talk more about conversion costs when we get into chapters 17 and 18. But all in all, they have $250,000 incurred up to the split off point. And we've got to figure out how we're going to go about handling these costs. We have fine grade lumber, the main product. We track it in what is called board feet, which is a linear footage measurement. And the company can sell it for $6 a board foot. During the accounting period, they produce 50,000 total board feet, and they sell 40,000 of it, leaving a remaining finished goods inventory of 10,000 board feet. In regards to our byproduct, the wood chips, we can only sell those for $1 per cubic foot, and that's one of our volume measurements. They produced during the same period 4,000 cubic feet, selling 1,200 cubic feet and ending up with 2,800 cubic feet in ending inventory. Here is an illustration so that you guys can think of this visually. We've got $250,000 incurred up to the split off point for those joint costs. We need to somehow allocate those between the two. Again, we've got a main product and we've got a byproduct. Here we've got a side-by-side comparison of these two separate methods. Notice at the top we are putting the revenues for our products under both the production method version and the sales method version. We do have the main product revenues for the period. We did sell 40,000 board feet at $6 per board foot. Therefore, our revenues for the period under either method is $240,000 for the main product. But notice the difference in how the revenues for the byproduct are recognized. Under the production method, we are not going to recognize the 1,200 cubic feet that were sold at a $1 per cubic foot. We are going to handle that differently down farther below. But under the sales method, we would recognize that as revenue. So 1,200 cubic feet times $1 per cubic foot equals $1,200 in revenues. Therefore, we've got total revenues under the production method is $240,000, but under the sales method we show $241,200. Now, let's calculate our cost of goods sold. Again, we've got the total in joint cost, those total manufacturing costs for the tune of $250,000. That is shown the same under both methods. But then we've got some changes that we need to account for based on the production method. Under the production method, we deduct the selling price for all of the byproduct that has been produced. Not for just what was sold, but all of it. So we're going to back out that $4,000 for the revenues, even though not all of it has been sold yet. Once we do that on the production method side, you notice that we have net manufacturing cost of $246,000. So the revenues of the byproduct have offset or reduced our net manufacturing cost under the production method. Under the sales method, we don't deduct anything because we're handling it a different way. So notice that the net manufacturing cost remains the same, the $250,000 under the sales method. Regarding what is left in inventory, we need to actually deduct what is still here in regards to our main product inventory. We have got $49,200 under the production method, but under the sales method we have $50,000 worth of main product. How are we able to get that? We are going to wait out the fact that we've got 10,000 board feet of fine grade lumber still here of the 50,000 that we produced. Alright, so if you get that percentage, it should be 20%, and multiply it times the net manufacturing cost for everything, which was $246,000. Again, I'm pointing at this line right here. $246,000 at that percentage means $49,200 of that is still here in ending inventory in our main product, the fine grade lumber. If you do the same calculation, but this time using the $250,000 under the sales method for what the manufacturing costs were, you get a different number, and it's $50,000. So our finished goods inventory for the main product is going to show up as 50. Of course, we're going to subtract those line items from the net manufacturing cost in order to get the cost of goods sold. All right, so cost of goods sold is going to the income statement. $49,200 for the main product inventory is going to the balance sheet for the production method, but under the sales method, we've got cost of goods sold at $200,000 with $50,000 going to the balance sheet for the fine grade lumber. Therefore, once we've done that, we can subtract our cost of goods sold from our revenues to get our gross margin. Notice that we've got quite a bit of a difference under the two methods. We've got $43,200 or 18% under the production method, but under the sales method, we've got $41,200 and a gross margin of 17.08. With our production method, those wood chips will go sit on our books at $2,800, and the main product, of course, is still that $49,200. So there is an inventoriable amount there for the wood chips. For the sales method, you can see that there is no ending inventory byproduct wood chips value.